Come on, 2, 3.
Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Wednesday, January 19th, 2022. And our top story today, thinking about buying or renting a home? We'll talk about the latest real estate trends in 2022. And joining me now to discuss this and a lot more is Damon Kennard of Douglas Elliman Real Estate. Damon, great to see you. Happy New Year. Thanks so much for joining us on the program this morning.
Happy New Year. Good to see you.
Great to see you as well. Hope 2022 is off to a great start. You know, I know you work in the Manhattan, New York area, which is a wide swath of territory to cover. But I want to talk about some real estate trends. You know, we've gotten some signals from the Fed that they're going to raise interest rates. But let's just start off with some basics here. Let's talk about affordability. How affordable are you seeing rents and homes come down in the area, or are they still up here?
No, rents and pricing are actually increasing pretty dramatically. Certainly on the rental side, we're seeing really dramatic jumps in the rental market as more and more people are feeling comfortable coming into New York City. Younger people are starting their jobs, and that's being shown really strongly in the rental market. In addition to the buyer's market, we're also seeing a ton of activity as the trend continues to go upward in terms of the number of sales. And as a result, we're seeing increased raised prices as well.
Damon, when it comes to the rising interest rate environment, and there's not a direct correlation to mortgage rates, but there's the mortgage-backed securities aspect that we've covered on the network with both you and others. Are people, when you're talking to your clients, are people mentioning, okay, well, mortgage rates are going up, we have to lock in something right now?
Absolutely. There's definitely a sense of urgency that occurs when the news comes out that the Feds are going to raise rates, which of course has an effect, even if it isn't direct. There is an effect that happens on mortgage rates as a result of this, not only just the raising of rates, but the cancellation or the pulling back of the bond buying that the Fed has been notorious for the past, God, what are we, like 15 years now into this? So yeah, that's obviously going to have an effect on mortgage rates. And so every dollar counts ultimately, and people want to lock in as low a rate as possible before we start to see those effects.
What about millennial? You know, you and I are both Gen Xers, right? So we're kind of, but the focus really is on this bigger generation of people, millennial and Gen Z. Are they buying more? You mentioned people are coming to New York City. Look, you come to New York City when you're a youngster, a young'un, right out of college looking for a job. But are you seeing concerns about affordability of housing if you are in this generation?
Well, sure. I mean, when you think about New York City and particularly the Gen Z, I guess millennials are pushing 40 now, so we can't really call those the young whippersnappers anymore.
Younger than me.
Yeah, certainly. Younger than us, definitely. But like as we look into that younger generation that moves to New York City, assumedly they're moving here with prospects or jobs in hand. And they kind of have a clearer vision, certainly than maybe we had when the economy was the state of the economy when we graduated. But they definitely have an idea of kind of where they want to go, and they have a plan of how to get there. And so, and they're also making more money, certainly in New York versus other parts of the country. So they're able to kind of budget a little better as we're seeing like inflation, as we're seeing the effects of more interest rates. They're just able to budget better, and they're just a little bit more savvy about it. They're certainly not looking to get into the market. They're going to try. And I do think that because they do want to kind of take advantage of some of these rates that are there now, but if they don't have they just don't have enough time to build the assets in order to make that purchase to take advantage now.
Yeah.
Now,
go ahead.
yeah. Oh, sorry. Yeah, I'm slight tangent. Now, if they are fortunate enough to have resources like parents and family members who can actually kind of provide some of that seed money, then yes, they are going to take advantage. And I have worked with certain young professionals who are able to do that. But if you're just kind of starting out and you're forging your own path, then you're just going to have to wait.
Yeah, Damon, sorry again for interrupting you. As you know, it's sometimes hard when you're doing things virtually. Let's talk about cryptocurrency for a second before we go to the commercial break, because Bitcoin, before this most recent volatility, really saw the run up, and we continually cover on the show the continued growth and expansion of cryptocurrency. But is that a transactional? Is that something that you're doing more and more transactions in, whether it's you or the firm in crypto?
I'm not seeing it yet. It's so interesting that it's kind of a strange marriage, potential marriage anyway, of crypto, which is a very highly volatile currency, and real estate, which is kind of viewed as a very stable asset. However, I do believe that with new development in particular, there's a lot of potential there, especially since a lot of the investors in those types of properties want that privacy, especially if they're coming from other countries where the rules of capital being able to leave the country are very strict. Crypto provides that opportunity for them to maybe skirt some of those rules and still be able to park some capital in New York City real estate. So it ultimately depends on how much the developers themselves trust crypto as a valid currency for accepting from potential investors.
Yeah, well, I'm still leaning. I like exploring crypto, but I'm still leaning towards a good old U.S. dollar, at least for now. Damon, I need to take a very quick break. When we come back, we'll talk more about what this means for you if you are going to be buying real estate in the next 6 to 12 months. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The Motley Fool helps its members invest and save with expert stock picks aimed at multiplying their net worth over time. As a member, you'll get 2 monthly stock recommendations, access to their best current and historical stocks, tracking of your favorite stocks, articles, reports, and all the expert insights you could ever ask for. The Motley Fool takes the guesswork out of investing, so you can focus on the important things in life. Join now for less than $2 a week.
Welcome back. We're talking this morning to Damon Kennard of Douglas Elliman Real Estate. Damon, thanks so much for sticking around with us this morning.
My pleasure.
Yeah, really interesting conversation, and it's nice to see New York and a lot of urban areas, cities, return to the stature they had before the pandemic. Obviously, it takes time, and there's a lot of things that have to happen around the pandemic. Damon, I want to ask you about when you look in your crystal ball, and we're not going to hold you to anything, but just get your expert opinion. You've been doing real estate for a long time. Are we going to see a more balanced real estate market in 2022, meaning not these wide divergences in prices versus affordability?
A balanced market, that's a good question. I think that we are in a bit of a retracement here. So we're getting back to that pre-pandemic state where the market was. And the market was pretty hot before the pandemic as well. But ultimately, there has to be a top. I mean, you can't have that 25%, 30% year over year growth every year. It's just not sustainable. So ultimately, and we talked about the mortgage rates as well. So there's a lot of urgency to get into the market now as well. So I do think in this kind of short term, we're still going to see continued activity as buyers try to take advantage of lower rates and as buyers start to kind of take advantage of pricing, which is still like right around those pre-pandemic levels, but not quite at the all-time high yet. We're still not quite there yet. So there's a bit of room to run. But once we kind of top out and you start to lose some of those buyers as the rates go up, a 2% interest rate increase can really affect someone's affordability. And next thing you know, buyers kind of start to fall off. And then inventory starts to, as a result, it becomes a bit of a domino effect. And then, yes, so you do start to see that kind of balance in the market where things just kind of top out a little bit. Everyone kind of takes a breather and really just considers their purchases. They aren't quite as exuberant about jumping into the market. So, I do think a balance is coming, not in the near term, but certainly within a year or two, I think we'll get there.
David, let's talk about qualifying for a mortgage. We've got the potential of rising rates. In fact, we've seen them go up. I think the highest they've been within 20 months, if I'm not mistaken, if I'm right on that statistic or not. But what do I need to qualify? Are the constraints to get that low rate? So even if there is a low rate, I've still got to qualify for that low rate, and that's predicated on my income and a whole bunch of other factors.
Yeah, absolutely. I think that one of the primary principles is that cash is king. You want to have as much in liquidity, post-closing liquidity as possible. I think especially moving forward, banks are really going to want to see a lot of liquidity in their potential buyers. It shows more stability. Also, if you're willing to put more money down, banks like to see that. That again shows a stable purchaser. Potential sellers like to see that as well. It shows an invested buyer. So it's all about trying to hoard as much cash as you can, especially with interest rates going up. You can get a little bit more return on your money while you're saving up. So that's really important in terms of helping with securing any loans. You really just you just want to establish your credit history. That's always just a really fundamental idea, but just especially during this pandemic where a lot of people are actually struggling to maintain their payments. I think that being one of the lucky few that can just stay on top of it, you really want to be able to do that and really take advantage of that opportunity to build your credit as well as building your capital.
And I'm assuming it's still not cryptocurrency that you need to put down. No, no, I'm kidding. Damon, the rule of thumb when we were growing up was 20% of the home price you needed to put down. Is that still the rule of thumb? Say cash is king, and you can't do an all cash deal to buy that nice apartment on the Upper East Side. Is it 20%? What is the kind of the rule of thumb where you've seen in some of the deals you're a part of?
Yeah, 20% is still the rule of thumb, especially when so much of the inventory here is composed of cooperative apartments or co-ops. So those require board approval. And because the board, you're essentially buying shares in a corporation as opposed to real property. So obviously your business partners are going to want to see you have more skin in the game. So they will definitely require at least 20% down. Some of these cooperatives actually require 50% down in some cases. It can be pretty intense with their restrictions. But yes, 20% down is a great rule of thumb. If you're purchasing maybe a townhouse or a condo, townhouses obviously don't have boards. Condo boards, they don't quite have as much authority. So you can be a little bit more flexible with your lending product. But of course, what that means is that your monthly carrying costs go up significantly. So you really want to consider whether or not you want to take on that higher monthly carrying costs as opposed to putting more money down and bringing your costs down as well.
Yeah, I'm seeing spreadsheets in people's future to figure out what is the right decision to make in the short and long run. Damon, we're going to have to leave it there. Excellent information, great conversation, and we look forward to having you back on the program again very soon.
Thank you very much.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in lifestyle, wellness, finance, tech, so much more in all in one place, check out today's edition of our daily and free newsletter, The Morning Pulse. Want to search our archives or see our latest content? Then check out our streaming partners like Amazon, Roku, Samsung, and over 100 more. We're back again tomorrow. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Waiting here for you to take and drink of. But if you're tired, come on.
Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.